All right, we've got just over a minute until we get things started on a special Sunday morning edition of our Trade Ideas stream, so hang tight. All right, that is the timer. We are going to get rid of the notification, get this window out of here, and we are going to get things started. So, for those of you who are on, we've already got someone in the Twitch chat. What's going on? Memnoch, please tell me I'm pronouncing that right. That probably was terrible, but tried my best. Welcome back to the special Sunday morning stream that we're going to be doing because, quite honestly, I wanted to watch Sunday Night Football tonight. So we're moving it to the morning. Hopefully, those of you who are unable to make it this morning will be able to watch the replay of this tonight, or I guess at any point today. So let's get into giving them some content to watch. We're going to kick this off the way that we always kick it off, with a recap of what we did last week. And objectively, it was a good week. We returned 1.01%. The S&P 500 returned 0.57%, meaning once again, we came out as winners, right? We outperformed by 0.44%. And, week before, we outperformed by almost 3%. Week before that, we outperformed by about 2.37%. And we've got a pretty good stretch of weeks where we've outperformed the market. I think the last time we underperformed was, there you have it, back middle of July. So we're on a really, really good roll right now. Things are going pretty well for us. Our main goal right now is to keep it going and not mess that up. We've got Sierra, we've got Cash Money in the chat. Love to hear that we can get the UK people in on the streams now, since we're a little bit earlier. Here in the YouTube chat's a little bit upset we don't have the face cam yet, but I've got some news for you here. I think we only have like 6 viewers right now, so not too big of a crowd. We get those numbers up, something might come along. We'll see. But yeah, getting back to the point that we were talking about, it was another really solid week. But in prior weeks where we were just cooking and it was just green from top to bottom on that weekly tracker, green from top to bottom, we made a pretty big mistake this week, and it has to do with TMC. So honestly, I think let's talk about that one off the bat, because that's one that, it's easy when we get in and out of these winners and we stack profit on profit on profit on profit. But, the real value of the strategy and the most important thing to know about this strategy is what to do when something starts moving against you. And TMC really started moving against us. So let's go to the TMC trade breakout tab. I finally had some time to clean up the spreadsheet a little bit. I updated the trade performance. I've still got to get collateral and returns put in there, but at the very least, I've tallied up the profit. And if you could see, the conditional formatting didn't quite make it all the way down here, but we've really only lost 4 of our last, if we, a little selection bias here, but start right there. Of our last, let's see, 76 trades, only 4 of those are negative numbers. This one should turn out positive. APT should turn out positive. ACIU, we locked that one in for a loss. And then the other one that we're going to talk about right now is TMC, which is probably going to be a loss. But still, the fact that we only have 4 negative numbers over the last 76 trades, we've been on a really solid roll lately, and we are going to try our best to keep it up. We're at an 89.3% win rate. So, we're not going to win them all, but we're coming pretty close. So I'm happy with how that has turned out. But back to what we all want to talk about, TMC, what happened with that one. We initially got in, if I could pull the chart up to give a little context about what we were seeing when we entered into the trade, why we did what we did. So as you could see, it was a SPAC. We have the typical SPAC chart. What if we back it out to 180 days? You've got that price floor right around $10 a share. Excuse me. And it is what you typically do normally see from a SPAC, where you get some sort of hype, levels out at 10, spikes all the way around, never really gets too far below 10, then goes into a merger and slides afterwards. We definitely were expecting a slide, but to be honest, we definitely also didn't expect this big of a slide this quickly. And who really could? Because the last 20 days, even the last, this is September 16th pre-market. So this was 10 days ago pre-market. This thing was almost at $16 a share, and now it is down around $5 a share. So that's a 66% drop on this stock in about 10 days. Dashio, welcome. Good morning. We are live right now. And for reasons disclosed earlier, the 49ers are playing the Packers on Sunday Night Football tonight, and I'm a huge 49ers fan, so I wanted to watch that. So we are doing this right now. But back to the point that we were getting at, TMC basically has dropped off 66% in 1, 2, 3, 4, 5, 6, 7 trading days. That's an enormous drop. If we take a look at RSI, I mean, it's getting down into the blue. Typically, when it gets down into the blue, it's going to come back up. We don't know what's going to happen. Could it keep going down further? Absolutely. But to back up a little bit, what we were looking at was we did see that typical SPAC chart, and we saw that 5 and 6 strike puts were offering decent premiums off the bat. I think we got if we click back over here, there you go. We got 45 cents a premium off a 6 strike put, 25 cents off a 5 strike put. Our initial break even was $5.40 for what would be, roughly a 1 month trade. So as long as the stock didn't drop 50% in a month, we were going to be okay. And in plain English, I'm okay with that approach and those odds. However, as we could see, it did drop that much, and it didn't take a month. It only took about a week. So we were in a little bit of hot water on that trade. So what did we do to manage it? Off the bat, we had October 15th expiry. We always like to play the nearest term expiry when we enter into trades like this. And about a week into the trade, they actually came out with weekly expiries. So I figured the best plan of action for us is, if you take a look at the weekly option chain right here, if you go to the ROR, our favorite little metric, there is some insane weekly ROR on cash secured puts that are near the money right now. So I really wanted to do our best to take advantage of that premium that was being offered right there. And, if we get into a situation where we're able to get profit on October 1, which we see that we have set up right here, we'll get about 700 of it back. We closed out our initial October 15th puts because, to be honest, with how quickly this thing was dropping, I just wanted the additional flexibility that weekly expiries offered, right? So we originally had options that expired here. We now have them that expire here. So come next Friday, we can make some additional moves to manage the position. And it really just is going to depend on what this finishes out on Friday. It could be higher, could be lower. I have no idea, but we've got at least a little bit of a short-term cushion for what we're currently holding. So we're just going to hold on tight to at least these and then see how that shakes out for us. But the idea is, right, if it stays at 511, because we don't know if it's going to go up, we don't know if it's going to go down, I think the most objective way to evaluate our position is if the stock just stays where it is. We closed out initially for a $1,700 loss on these first 2 legs, which is never fun to do. But if it hangs tight at 511, we're going to scalp about 700 of that back to get down to a negative, $1,000 overall loss, which isn't too bad. And then from there, we could take a look at, October 8th if we do choose to keep playing that, and potentially keep clawing back between the 8th and the 15th, the amount of premium that we lost on the initial October 15th puts. But again, this is one that, you don't have to turn every trade into a win. One of the most important things out there is just to make sure that you don't completely blow up your account with one trade. And to illustrate that point, here's our 2020 tracker. I don't know if some of you have been poking through our profit tracker and have seen this already, but we were having a really good year in 2020 when we started publicly tracking this. Things were going really well until about the end of September, which, coincidentally is what we have run into right about now. And we ran into October when we got in on Hyliion, and we lost a significant amount of money. $17,000 that week, $13,000, $9,000, $6,000. But all in all, in October, we lost $47,000 because of Hyliion. And we had zero diversity in our account. We literally were treating this as, it's kind of a trading account. This is fun. Let's keep going all in on positions, kind of ride the lightning. That is not at all what we do right now. Since then, we've adjusted the stance that we take. We've adjusted our approach to diversity in our positions. And, things have gone better. Since then, we made $29K in November and December of 2020. And then in 2021 so far, we've made about 80 grand back. So since then, we've made about 100 grand back after this loss. So we are still in the green, but, it's never fun to have this kind of a loss. Point being, though, sometimes the most expensive lessons that we experience are the best lessons for us. So when I was entering into this trade, I was kind of having flashbacks to this Hyliion trade that we had from quite literally a year ago when we were heading into October. So what I didn't want to do was potentially hold on to something, being these 10, 15, 6 and 5 strike puts that had a longer time frame that I really kind of gotten in trouble with, and instead wanted to go a little more short term, something a little bit more manageable, and most importantly, keep the position a little bit smaller for us, right? I mean, fully cash secured, these are about $10,000. So that's something that I'm perfectly comfortable with. If we keep dropping from here, it's not going to ruin my account. I'm not going to lose $50,000 again. So, taking the lessons we learned from there and applying it to here, we don't need to turn every single trade into a winner. I mean, even if this thing finishes at 511 come next Friday and we're at a $1,000 loss, that's not the worst thing in the world when a stock drops 45% on you in such a short time frame. So this is one we're just going to hold on to what we got and evaluate it come next Friday. The important thing is, look, last week, the cumulative effect of our TMC positions loss is 2160. We want to leave that in the past. And despite that big mistake that we had last week, we still outperformed. It's still a win overall. And now there is a little bit of a bitter taste left in our mouth, because if we didn't have something like this happen and we just had zeros down the line here, we never touched TMC, we would have had a monster week, right? We would have made about $4,000. But, that's just the reality of trading in the market. You're not going to win every single trade you get into. And the fact that we could have had such a disastrous trade and still outperform the market, I think is a testament to our strategy. So, wiping the slate clean, rolling down to the 10-1s. And again, if this finishes at 511, the price it's at, this is going to expire for about, 39 cents. That's going to give us a $510 profit. This will expire worthless, and we'll make $1,100 of it back this week as we try to keep the ball rolling. So I don't really want to fall too much into the sunk cost fallacy and let this keep killing us week after week after week, but instead roll it to something more near term, almost treat it as a separate trade, and then hopefully the results of that net against each other to get us out of trouble. But obviously, definitely never fun to have a big loser like that, but this is how we manage it. But with that in mind, the rest of the week looked really, really, really good, right? So trades outside of TMC that were alerted this week, I guess we can include SPIR up here as well. They made $4,380. Things were kind of just cruising. ACIC is a former SPAC. Underwent a merger. I think the premium was a little bit overpriced. So we made some good money there with 6 strike puts, and it really only dropped down to about the $9 a share level. Because you might say, why are you getting into TMC? It's a SPAC. It's dangerous. It could drop off after it merges, and you're 100% correct. But if you take a look at the context of these other trades, this was a similar setup. This was a similar setup. A JOBY, similar setup, and I think that was the only other one. And from those alone, we made $2,000, which pretty much nets out to zero against these. And if you take a look at what we did in the prior week, we had some similar names with similar setups, right? We had Rockley, we had LIDR, which is one, JOBY, where we made $775, and the week before that even we made even more. So, in aggregate, these trades are working, and it is kind of what we preach, where we say, even if you do have a loser, and the loser might be bigger than the winner that you have next to it, but the amount of winning trades that we have is going to far outpace the losers. And that's what we've seen, because this is a big, big, big loser. I mean, in a literal sense, I guess it could get worse than this, but realistically, it really can't get much worse than what happened to us with TMC last week. And the fact that that didn't even Didn't even do enough to drag us to a losing week, was huge for us. And we're going to roll all these into next week. And slate has been wiped clean, and I like where we stand for next week. But before we get into that, I'm just quickly going to run through the rest of these. APT, that was really the only other losing trade. We sold a 7.5 strike put when the stock was trading at about 770, 775. We got a breakout tab for this we could take a peek at. There you go. It was trading at 775. We did the quote-unquote manual assignment option, where instead of waiting for these shares to be assigned to us and waiting until Monday morning to sell covered calls, we bought these to close them, $300 loss, and then we just purchased the shares at market price. And that has the same net effect as if we took assignment, but the added benefit is that we're able to sell the covered calls on Friday afternoon, as opposed to having to wait until Monday morning, where if we had to wait until Monday morning, something could have happened to APT over the weekend where we wouldn't have had that downside protection that these 7.5 strike covered calls offer us, right? So now the question might be, why does this have the same net effect as just taking assignment? And the answer is, let's say it's at 708, which is where it was when we purchased the shares back. We could close these for a 20-cent loss. And again, if the 7.5 strike put, if APT expired at 708, there's a 42-cent difference between that 7.5 strike and the stock price. That's exactly what we got right there, meaning a $300 loss that we took on the puts in exchange for, zero net effect on the shares. Well, if we had just let these expire, collected the whole premium, and then purchased these for $750, you would have a $330 gain on the premium from the puts and a $630 loss from the shares. So the difference, right, if you took assignment, your basis in the shares would be $750, but you get to keep all the premium. However, the net effect here again is that same minus $300. So instead of waiting for the weekend, we just take that $300 loss on the puts, purchase the shares at market price, we get that 708 basis, and then we are in the clear, and we are free to sell those covered calls as we head into the weekend, which we have done. And again, here's our break-even price tracker off the bat. We sold the 7.5 strike put for 22 cents, which gave us a 728 break-even price. And then we took assignment of the shares manually using the method that we just described. We sold a 7.5 strike covered call for 15 cents, meaning that our break-even price is now down to 713. So in just one, really not even one short week, right? It's been less than a week because we opened this trade on September 22nd. We've gone from playing a stock that was at 775 to now having a break-even price of 713 in less than a week. That's an 8% total reduction in the price of the stock. So as long as the stock doesn't drop, theoretically 8% in that amount of time that we're playing the trade, we're going to make money. And, we are actually, if I go back and put the actual Google Finance APT, it's at 714, so it's a cent above our break-even price. So if it finishes where it is right now, it's dropped less than 8%. We're going to come out with the total profit, despite, what's a relatively significant drop on a stock in such a short time frame. And if it doesn't work out this week, we're going to do the same thing again next week. One little, wrinkle with this one that was a little bit strange, and now what we were going to do is if you take a look at the options, normally we would enter into a covered strangle, right, where not only will we sell the 7.5 strike calls for covered calls, but we would also sell 7 strike puts, because that would give us some additional premium that could further decrease our break-even price on a 1-week basis. However, when we took a look at the strikes of the options, really odd here, they were in dollar intervals at 650, 750, 850. So there weren't actually any 7.5 strike puts for us to sell. Now we could have sold 15 of like the 6.5 strike puts for about 6 or 7 cents, and then taken that break-even price down to 707 for the week. But for the amount of premium you're getting on that trade individually, it wasn't really worth it for me. So the idea is if APT keeps dropping and goes down, these are going to be worth more come October 8th than the 6 or 7 cents that we could have gotten this week. And that's when we would deploy that additional capital to continue to manage the trade that we had on hand. And then, that's really only a problem for the weekly option series. Once we get to the monthly here on October 15th, then you start to get them at a 50-cent interval. So we could have gotten what we wanted off the bat, but we're going to have to wait a couple weeks, and hopefully we get to the point where this thing jumps back above 750 at some point in the near future here. and we'll take home a $500 profit. We won't even need to worry about doing anything like that. But, that's what's happening with that one. Not every single trade's going to go our way. And even though it did look like a decent loss off the bat, you take manual assignment, you move that break-even price down as you head into the next week. You move the goalpost, kick the can down the road, so to speak, and eventually, we could keep dropping that break-even price forever. If APT has a green week, we're probably going to make money overall in the trade, and that is how the HT wheel works right there, right? You just keep moving that break-even price down. The stock price isn't going to drop forever, and eventually our break-even price will get below the stock price, and we'll take home some profit, take that cash, and move it on to the next one. But with that said, really nothing else of note to talk about. Palantir, SoFi, Draftkings, these were all kind of safer trades that we entered into for some nice little profits right there. NNVC was a great IV reversion one. And let's talk about that one really quickly, because I think this is a great example of looking at a trade where we like to play these big spikes in implied volatility, and I think this does a really good job of demonstrating exactly why we like to do this. So at a high level, before we jump into the charts, we made $725 in just a few days on NNVC, and here is how we did it. So if you just take a quick look at the chart on NNVC, and the study that I'm going to want to have up here is going to be implied volatility. And before I pull the study up, I will say what happens on these IV reversion type setups, what we're aiming for is you have a stock that's trading at a base, and it was trading relatively around this $4 base. Then you want there to be some good news, and I think they had some sort of good trial results. And from that good news, you want there to be a big spike upwards. Excuse me. And we see that big spike upwards as NNVC almost hits about $8 a share at the peak. And we did get a question in the chat that I thought was a good question, because we talk about RSI a lot when we enter into or exit trades. And RSI is, sky high, meaning typically we wouldn't want to enter into a trade when RSI is high, because it means the stock's overbought and it's going to fall back. So the question was, if RSI is high, do we still want to enter into this trade? And for IV reversion trades, absolutely, right? Because anytime there's a spike in price, RSI is going to go up, but it's this same spike in price that gives us the spike in implied volatility, which is the next study that I'm going to pull up, which gives us the opportunity that we've been looking for to enter into a trade here. So there you have it, right? Implied volatility is hanging out around this, 1.3, 1.2, 1.1 level. All of a sudden there's a big spike in the stock price, and it shoots all the way up to, above 2.3, 2.8-ish at the peak. I think after hours implied volatility normally looks a little bit weird, but we can call 2.4 the peak. But point being, you could see the general trend where IV's kind of around this level, shoots way up, and then inevitably IV, as we always say, is one of those things where what goes up must come down. So it pulls back down, and with it, it pulls the premium of the options down. So with this in mind, we sold 5 strike puts, and we got about 90, what was the number right there? 94 cents of premium. So while we weren't able to sell a put, right at the base, what we did was we sold a 5 strike put for 94 cents of premium, meaning that we would have about a 406 break-even price, which put us pretty much around that base. So we were happy with that amount of premium that we were able to get. But here is where this really gets interesting, right? If we take a look at the price history of this 5 strike put. So let's throw this up on the chart side by side with the price of the stock. So if we put this on the 20-day, put this on the 20-day, it already is on the 20-day, perfect. What you'll see is a big spike up, right? So these historically we're trading at about 1.4, and theoretically, if the price of a stock goes up, the price of a put will go down. And that's represented by this purple line right here, right? The theoretical price of the option. So there's this big spike in price. So in theory, the price of the option should be going way down. However, due to this spike in implied volatility, the premiums kind of hang up here a little bit. So we were able to get in right here for about 94 cents of premium at this point in time. And then from there, even though the stock dropped from about, I think, 7-ish to around $5 a share, so it dropped $2, which is a significant drop for a stock at 7 in just a few short days. While in theory the price of the option would be going up during this, the pullback in implied volatility was so great that the premium of the option actually decreased over that same time period. So we got in for 94. Even though it pulled back, we knew implied volatility was going to come back down as well. So the premium on the option went from 94 cents down to about, I think, the 70 cents that we were able to get out for. And then we closed half for 60, half for 70. There you go. Closed half for 60, half for 70, giving us the 65-cent average fill right around this level. And that's despite the fact that from when we entered to when we exited in just 3 or 4 short days, the stock went down, meaning the put typically would go up. This elevated implied volatility that we entered during put us in an advantageous position to where we were able to get out for a gain. And this is really as well laid out as we can explain the IB reversion strategy, because typically, you would expect the puts to go way down as the purple line indicates. They didn't. They kind of hung tight. And anytime you get this big upward price movement, they're going to drop a little bit, but theoretically they should be dropping a lot more, and they eventually will drop a lot more as long as it doesn't come all the way back down to where it was trading before. And like we mentioned at the top of when we discussed this trade, there was good news that preceded this big spike. So theoretically, with that good news, the stock should be worth a little bit more than it was worth before. So the idea is that thanks to that good news, it's not going to come all the way back down where it was before. So that's where the opportunity comes from. So anytime we see that kind of a setup, we're perfectly happy to enter into it. This IV reversion setup. And if you take a look, IV reversion trades are 36-2 since we have started using them. That's a 94.7% win rate. These average return and duration numbers aren't quite accurate yet, but the overall profit amount is, because this is still a little bit incomplete and I've got to fill all this out. But I was able at the very least to tally up profit by trade type, and that's what we're getting at, right? These have an incredibly high hit rate. We had one loser where we lost only $160, and the other loser is TMC so far. But that just speaks to how effective this type of setup is from an option selling perspective, and why that's something that we try to look for on a day-to-day basis during the week. A lot of our longer term trades where we say, hey, we like this stock at this level, those are the ones that we're going to enter into at the beginning of the week and let those play out. That's a lot of what you'll see right here. And this is about as big as our portfolio tracker will look as we head into a Monday. And then as indicated by the amount of, new indicators that we have in column G here, we've typically entered into a lot of different trades during the week based off this new IV reversion idea that we've been playing a lot, and we are very, very happy with the results of that. And another great benefit, and I think we've talked about this a lot as well too with these IV reversion trades, is that they're relatively disconnected from the overall market. So if you're worried that the stock market is going to drop, a lot of your long holdings, and if you're just playing cash secured puts on stocks that are more correlated with the market, those are going to lose money. However, the market could be all over the place. It really isn't going to affect the price action we see on a stock like this that's so heavily driven by news and has been up and down and all around. So in a way, not only is it diversity by stock, diversity by strategy, but it's also a little bit of diversity in your portfolio in the sense that it isn't really impacted by the market. So if there's a big market pullback and you have a decent number of these IV reversion trades going at a given point in time, you're not going to be as poorly affected as other investors in the market whose portfolios have a higher correlation to what's going on in the overall market. And I feel like we say this, and I've said this almost every week for the past month or two, is the fact that we're a little bit worried about where the S&P 500 is if we pull this off. We did start to see a little bit of a pullback here because people are a little bit worried on talking. There was a real estate crisis over in China. Jagged Octopus in the Twitch chat, how's it going? That looks like a new name. Welcome to the stream. We did start to see this big pullback in the market as people got a little bit scared. And I will say, with this big pullback, we weren't really affected at all. Now, the market did ridiculously rally in the back end of the week right there, back almost up to where it was trading before the big slide. However, once again, we're going to do what we do every week here. If you zoom out, this really isn't a ton. And even when you do see pullbacks in the market, I guess I might have to go to the 3-year to see a decent one. Like what we saw back in October of 2018, even when you do see a pullback, there are some green candles in there. There's going to be a little bit of a rebound, but a lot of those big slides are a little bit longer term than 1 or 2 weeks, right? This one lasted about 3 months. The last quarter of 2018 was the last decent non-COVID pullback that we had in the market. So don't let this green candle put you into a false sense of security or anything like that. But we always do want to be on edge, especially when the market, ever since the COVID crash, has more or less been taking a straight line upwards. So that is our thoughts on that, and that pretty much rounds out what we wanted to talk about here. We have some smaller trades, like Lucid is one that we think is pretty overvalued, and we're happy to play it down anytime that it does get run up a little bit. We had some SPX spreads where we played it when it was overbought, played it when it was oversold, and that's about all we got. So in summary, and once again, it took us about half an hour to get through this one, which is, I think, in line with the other weekly recaps that we've had at the top of the stream. 1.01% return, SPY only returned 0.57%, and SPY, again, is the S&P 500 ETF. That's what we benchmark our performance against. So we outperformed by 0.44%. Could it have been a lot better? Absolutely, because we lost $2,000 on TMC, which is kind of an unfortunate trade for us, but we're never going to complain when we, one, make money, and two, outperform the S&P 500, because that's our goal. If we do a quick year-to-date summary, here's the account balance on the year. We haven't lost money a single month on the year so far, and that's something I've been really, really thrilled with, and, isn't crazy. I mean, I'm sure other people who have a similar result this year because, again, the market has just been going up and up and up and up. But, we've done this with an approach that doesn't really rely on the market completely ripping the entire time. And most importantly, though, dollar value is kind of irrelevant because people's accounts are going to be different sizes. The most relevant metric that we have on here is our return on the year, which is 91.91%, and our performance against the S&P 500, where we are pulling away. July is where we changed up our approach a little bit that we talked about, where we started to use less buying power, maybe go a week or two out on some trades, and started targeting those IV reversion trades a little bit more. And I've been really, really pleased with the results. To whereas the first half of the year, we had some heart attacks with some seriously red weeks, and we got to a point where I think the longest streak of winning weeks that we ever had was like 3. Every time we got to 3 winning weeks in a row, it seemed like we would lose. And then ever since switching that strategy up near the beginning of July, we've had 10 weeks that are highlighted right here. Only one of those has been a losing week, and the one losing week was only $689, the magnitude of which, is less than half of our smallest winning week. Or I guess, it's just over half of our smallest winning week. But, point being, this approach that we've taken over the last month or two, while it was conservative because we were worried about the market, and that's why we changed up our approach a little bit, using leverage smartly and targeting some of these different IV reversion opportunities, I think has provided some really solid results. So I don't see us moving too far away from that strategy in the future. But with that said, that is the weekly recap. Let's get into the more relevant part of the stream, where we talk about what is going to be coming up for the upcoming week in the market, what we're holding on to, what we're taking a look at, and what we've got our eye on. We're about 36 minutes into the stream. We've got all the time in the world on this Sunday morning. So if there's anything that you want to see us take a look at, feel free to throw it into the chat. Normally right now I would take a sip of my water, but I've got a smoothie because it's the morning. So I'm going to take a quick sip of my smoothie. And then we're going to keep things moving along as we talk about the upcoming week in the market and what we are looking at to help not only us, but hopefully you as well make some money. All right, there we go. Hope you enjoyed the 10 to 15 seconds of dead air right there. Some good stuff. But again, top to bottom here, this is what we've got going for the upcoming week in the market. UWMC is one that we've been sitting on for a while. We've talked about this. I mean, as long as this thing finishes, we've for a while, so it hasn't been the greatest trade from a return to capital deployed standpoint. And to quickly answer that question we got in the chat, Dashio asking, what is blue highlighted? This week going forward, we've started to highlight the weekly expiries, right? So options that are expiring Friday, October 1st, just so I can quickly evaluate, on a week-to-week basis, how much of my profit could potentially be derived from options that are expiring this Friday, and how much profit could we expect from, longer-term trades like we have with December, January, November, October 15th expiries. And the way I do that is to say, hey, we know TMC is at 511, so if it finishes flat, that's going to be worth 39. This will expire worthless. This will expire worthless, and we sell all these out of the money. So if things stay flat, they'll all expire worthless, and we'll see that just from zeroing these numbers out with what we have set up on just the weekly blue highlighted trades, we're in line to take home roughly $3,000 of profit off of those. So that's a really decent number, right? Because that's a 1.7% return on its own. And I guess conceptually, when I set things up on a week-to-week basis, I'm trying to get to a point where I have a decent base level of profit that I can derive from weekly trades. And then the ones that I have to be more patient on really are just going to be an added bonus as they decay over time to add to this number off the bat from the weekly trades. So that is the idea with that. That's why those are highlighted blue. It's really just so I can more easily evaluate what's going on for the upcoming week. So UWMC, we sold those for $1.10, a 7.5 strike put. The thing has just continued to slide week over week over week over week. But fact of the matter here, right? If it finishes at 683, which is where it's currently trading, and doesn't move for the next couple months, or even, I mean, it could go up and we can make more than this. But if it doesn't move for the next couple months, we'll still take home about $2,000, which is a 21% return on the actual, collateral that we have invested in there. Not the biggest number annualized, right? Because we opened this in June. It was a 6-month trade. But, anytime we get that kind of annualized return, despite a 32% drop in the stock, we're going to be pretty happy overall with that. So if this thing pulls back up to 7.5, we're going to get even more than that. But it can go all the way down to 6.4 before we start losing any money. So, we're comfortable with that. We like the stock. It's going to be a little more boring of a trade than the others that we're on, but we're just going to keep it rolling. Rocket Lab, this is another one that we're super excited about. I loved the way that this thing's set up. We've talked about this before, but just to quickly, our KLB. Oops. Another one where there was this huge spike in implied volatility, got up to, 2134. And if we move it to the 20-day instead of the 3-year chart, it started to slide back pretty decently. Not surprised by that at all. But, what we do like to see is the fact that this spike in implied volatility is starting to come back down to earth. It was at about, 1.6 when we looked at entering into the trade. It's now pulled back to 1.2. IV reversion. It's coming home. If we take a look at the actual option itself that we were playing, hop over to the January expiries right here. We didn't have the greatest timing in the world on it because we got in, we got in I think at like 70 cents off the bat, and then we averaged up to where we eventually got to. Let's see, where did we eventually get to? Yeah, we eventually averaged up to 83 cents. So that was when that trade first came onto our profit tracker. If we go to the charts, I thought I pulled this one up. There you'll have it, right? So on this big spike here, and we see, let's make these congruent again, the 20-day to the 20-day. So 20 days ago, these things were trading at about $1.45, and that's when this was trading around 10. So not terribly surprising. But what happens, right, is when it runs up right here, and these two red lines indicate the same area. So, right when it was trading at 15, these were trading for about 86. It runs up even higher to around the 20 level, and while going from 15 to 20, theoretically, as indicated by the purple line, would decrease the price of the option. They kind of held relatively flat. Timing on the initial entry was not ideal because we sold them for 70 cents. But if you think about that trade in plain English, right, you're selling a 7.5 strike put for 70 cents of premium, meaning you would have a 680 break-even price on a stock that was trading around $20 a share. So, in a vacuum, I looked at that and I said, I think that's really solid value as long as it doesn't pull back 66%, throw back to the TMC logic. But as long as this doesn't pull back 60-something% in the next 3 or 4 months, we're going to be making money. So objectively, I was okay with the 70-cent entry. But as you can see, when it had its first spike or first little pullback, the option premium got back up to $1. So I started adding more and more $1. Eventually got up to this 83-cent average, which we're below right now. So we've made money overall on the trade. But, what's important to note here is the fact that theoretically the price of the option would be going up because the price is slid. The fact that implied volatility is coming down is holding this price right around the 80-cent level. So if we could get any sort of rebound back up to the 14, 15, 16 level, this is going to flush out pretty quickly. Or if it just hangs tight at this 13 to 14 level and continues to kill the implied volatility, this is going to keep falling and falling and falling. And if neither of those things happen, we could take comfort in the fact that as long as RKLB finishes above 680, we're going to make money overall in the trade by January. So while it might not be a home run, I mean, as long as this thing doesn't drop 50% from here, we're still going to make money. So if all else fails, the implied volatility in the short term doesn't drop back down. The price in the short term keeps dropping. So that's two things that have to happen for this to remain elevated. Even if neither of those happen, there's still a third way we could win, which is just pure price level at expiry. So that's why we were super happy with that setup. And again, when you go this far out of the money and you go with this far of an expiry, it doesn't take as much buying power to hold. So, this would be 40% of our account if it were assigned fully cash secured. And thanks to reduced margin buying power requirements from the fact that this is a January expiry and it's super far out of the money, the 7.5 strike, it only takes up about $15,000, so less than 10% of our account. And again, don't get too fixated on the $15,000 number. Pay more attention to this number because this is what's relevant between your account and my account. You might have more money than me. You might have less money than me. That's irrelevant. We could all get the same returns on a percentage basis, and that's what we are. That's what we're going for in here. So the fact that basically, we got in at 0.83, so we're slightly below that right now. But if this finishes above 7.5, we're going to pull an $8,200 return on $15,000 of collateral, meaning that we're going to get a 50% return on the actual capital that we have invested in here in 4 months' time, as long as this thing finishes above 750 right here. And even better than that, if the price goes back up a little bit, or as we mentioned, the IV continues to drop and it gets back down to this 60-ish level, I mean, we could potentially exit there for what would be a $2,000 profit off $15,000 in collateral, which is going to be just under a 20% return on capital in, what would be a month, which is a fantastic return. And again, one of those things that's relatively lower risk, because at the end of the day, while we might have some sort of a loss on a week-to-week basis based on what the price does, we know in the long term that 750 level, and more importantly, that 680 level for the overall break-even price of the trade is all that matters in the end, which leads to the question you may be asking yourself, like, it's a former SPAC. It clearly looks like it was just pumped up a little bit. What's going to stop this thing going back to 750? And to that, the comfort I have there is there's been some good news coming out here, right? They've won a contract to remove orbital debris. If you take a look here, it was initiated as a buy rating with an $18 price target by Deutsche Bank. Cowen initiated them with an $18 price target as well. And I believe, there you go, Canaccord Genuity started them with a $30 price target. So you have three analysts who have coverage on this, and they have price targets at 18, 18, and 30 up here. So if we're to fall all the way back to 7.5 or, we're at 680 for our break-even price, that would take a lot and would kind of go against what people who have a lot more time to dedicate to analyzing the stock and do it professionally have come to the conclusion of. So that's what I'm really happy about as well. Anytime you can get something like this where IV is elevated, you can sell deep out of the money a little bit longer term expiry to take advantage of the IV fall off. And if you have some sort of basis for a backstop on the price, meaning that, you have some sort of justification for the price to be up in this level, which we have through these analyst price targets, I think that's a home run setup. And while we have pretty much broken even on the first 3 or 4 weeks that we've had this trade open, for the reasons I just stated, I think it's a good one to keep holding on to. And if you're not in it already, now presents another really good entry opportunity. So that's what we've got going with that one. SPIR, really similar situation, just shorter timeline, right? It's 7.5 strike put. One of those stocks that was a former SPAC, SPIR. Former SPAC, if we go out to the 180 day, you'll see the price action a little bit better. It was down to 827 before, so the downside definitely is there. But the question is, from this 19.5 peak to the 13.87 base, which if you pull up Rocket Lab, very, very, very similar. How quickly could it actually get back down to the 750 level? One, implied volatility is still relatively elevated, so we can get some benefit from that right there. But two, with this, let me pull it back up right here really quickly, with this November 19th expiry that we have on here, there really isn't a ton of time. It's going to have to get back down to 750 in 2 months time from now, whereas Rocket Lab had until January. So that's, it could happen, but we're happy with those Rocket Lab price targets and the amount of premium that we were able to get off the bat. But with SPIR, not only would it have to have that similar drop from 14 down to 7.5, it would have to do so in just 2 short months. And if it doesn't do that, pop back over here, this is going to expire worthless, and we're going to take home $2,200 off $7,000 in collateral, which is, about a 35, 40-ish% return off the top of my head, I think. So that's another really solid value for just 2 months worth of a trade. And that's one that, while we did highlight these weekly trades in blue, the idea is that these longer term ones that we have going week to week to week are going to kind of add to that. So if we put these back to where we had them before, right, where if TMC finishes flat, that's going to happen, that's going to happen. If everything finishes flat, these will all hit profit, and we'll have about $2,800 of profit from those. The idea is that, these are also kind of decaying in the background as these potentially drop on a week-to-week basis. Then we'll also get a little bit extra from these to kind of add to what we already had. And as all of these individual trades and diversity in different strategies, expiries, strike prices, and approaches work together, we start building on some really nice trades, and that'll allow for some decent cushion in case, 1 or 2 of these go wrong, because we're not going to win every single one of our trades. But the hope is, with how many different trades we have in play, the approach that we have is one that's a very high success rate approach. So the winners are going to outweigh the losers, and this is how we project those winners to look on a week-to-week basis. And if we could, come home with that 2.27% return, that's a phenomenal return on a weekly basis. That's a big time week right there. And that's just with our trades that we have lined up for the start of the week, right? Like we pointed out a little bit earlier in the stream, we always like to add on a day-to-day basis. We love to add these individual trades. And how do you know when we're going to make these trades? Because, it's tough at the beginning of the week to go in and say, on Monday, I'm going to do this, I'm going to let it sit. Because that's just not the reality of the stock market, right? You could wake up Monday morning and by 10:30 a.m., your entire plan for the week is already out the window. I think we come in with a new plan every single morning and sometimes almost every single hour. So this is a great time to have some shameless self-promotion for our Discord server. This is where we alert every single trade that we make. If you're new to the stream or you're following along and you're not already in this is how you're going to get this information. We get questions a lot for those people who follow our tracker and saying, how do we know when you're entering into this trade? This is the answer. We have an HT Trades channel in here. Every time we enter into a trade, we alert it at the second. We alert quantity, we alert strike, we alert price we got it for, and we give a little bit justification for why we're doing what we're doing. And if you're in our main Discord server, we have one free trade that we give away every single week. But for every single trade that we get entries, exits, things like that, when we're making $1,000 of profit, $140 of profit in just a couple days, these are all getting alerted in this channel. We've got a premium chat where there's a lot of good discussion as well. We write out some trade plans for some trades. We have a watch list. We have the scanners that we use to come up with trade ideas. And you could join that by going to hourglass-trader.com. And the link to join our chat room is right there. Join the 24/7 chat room. And to get those premium trade alerts, you could sign up for HT Premium, which comes with a week free trial if you want to, if you're following along, you think what we're doing is interesting and you want to just give it a shot. No financial commitment. You can get a 1 week free trial. Additionally, if you use our Webull referral link to sign up for an account and deposit $100, you'll get a couple free stocks, and we'll hook you up with a month of HT Premium for free. So there's a couple ways for you to, kind of get your feet wet with what we're doing and what we offer from a trade alert and, option selling information perspective. So, no financial commitment up front. Everyone's situation is different, but I think a lot of the people who are a part of HT Premium right now and get those trade alerts that we put out can attest to the fact that, definitely worth the value for what it costs. And it is, I don't think I know, but I was waiting for it to load, but it's, $25 a month with that 1 week free trial, or you can get $225 for the whole year. That's a discount of 25% from the monthly plan. We've got people who are in the $250,000 profit group. I mean, Cliffo is someone who is, at the time of giving us the testimonial, was in the $100,000 profit club, but he's since moved up to the $250,000 profit club. Just a lot of people who have been very successful with this, and I think can attest to the effectiveness of our strategy. So if you want to sign up to get every single trade alert as we make them, so you can, set your portfolio up similarly every week and hopefully get some of these results that we've been getting lately, that is the way to do it. Hourglass-trader.com. But that's the little spiel I'll give, and we'll get right back into the good stuff. We've got this TMC trade set up. We talked about that one at the top of the stream. Objective. I mean, it sucks that we lost money off the bat on this one for our initial setup, but objectively, I like where we sit. These things were sitting at 90 cents and 62 cents, meaning that our break even on just a weekly basis on this is 5.5 minus 0.9, meaning if TMC finishes above just 460 this week, this individual trade is going to make money. This one's going to make money. So that's something that will generate some profit for us on a weekly basis, just those right there. ACIC is one, though. That was the ticker of the SPAC that turned into ACHR. This has since died down. I think it's at about like 15-ish cents a piece, but we're probably going to look to get out of that one pretty soon if we can get down to about 10 cents right here. We've got a question saying, do the alerts get sent out by text? You have a 9 to 5. What we do for the alerts, they don't get sent out by text, but what you can do is if you turn on your notifications for Discord, we put the little HT premium tag here on the back end of the trade alerts. That means it'll essentially come to your phone as a push notification, no different than the way that a text message would. And I've always said this is the perfect strategy for people who are busy. I personally work 50, 60 hours a week at my full-time gig. But the great part is, right, it only takes a couple seconds to set up each of these trades. And we're not hovered over the keyboard, hovered over the screen, looking for perfect entries and perfect exits, for example, right? This Rocket Lab trade we entered into 3 weeks ago, it's still good for entry. And you don't need to know exactly when to exit, right? Because the more time we wait, in theory, the more that these options will decay. So if you miss one initial exit opportunity, all is not lost. There's probably going to be another decent one in the next day or two if you just wait. So one thing that I'll say about the strategy, and I think it is the perfect strategy for those who are either busy with work or two, just don't want to spend a ton of time, glued to their screen, actually actively trading. You want to go outside and enjoy yourself, which I am fully in that camp. But I think this is a great strategy for that as well. But those trade alerts do come via push notification from this because we put that little tag in there. So if you enable notifications on our Discord server, you're going to get those notifications no differently across your phone than if you had received a text message. Moving down again, Draftkings is one that we're happy to play. We played it last week because there was some news that came out that they were looking to make an acquisition of another company. And there, you see this big red candle right there. That is what that was from. Draftkings is one I'm a fan of. I will generally say that if something is a former SPAC, I'm not a huge fan of buying it too much above net asset value. However, this is one where it started off at around this $20 level. So that the net asset value was a little bit larger than typically, what you would see from other SPACs. And two, this thing went public over a year ago via SPAC, right? This is April 2020. So it's been about a year and 5 months. And sports gambling is something that's only going to get more and more widespread as we move into the future. I think I'm very bullish on the industry as a whole. So I think this is one of the few companies where this increase in stock value from net asset value at the point when it went public is actually justified. So I'm happy to get in near these levels. 48 is what I played off the bat, I think. I think 50 is what I played off the bat yesterday. Just because there was that big spike in implied volatility that we like to talk about so much from that big red candle that we saw off that news, right? And there you go. You see the elevated implied volatility off that big drop. We were happy to scoop up some 50 strike puts, get out of those for a profit. We did jump the gun a little bit because I wanted to lock in profit. We could have made a little bit more if we let those just right out the rest of the day. We left about $90 on the table, but you're never going to go broke by taking a profit. Smart, consistent, compounding profits is the name of the game with our strategy. So that's what we're going for here. One of the worst feelings out there is when you have a trade that's been profitable all week, you want to get greedy and hold it until Friday so you could hit max profit, and then it turns from a gain to a loss. That is a feeling I've had way too many times in the past, so it's something that I do my best to avoid and hopefully get other people to avoid as well with what we're alerting as far as those trades are concerned. But with that said, we're happy with Draftkings at these levels, so I sold a 48 strike put for this upcoming week, and we've got, 48 cents of premium, meaning that break-even price is going to be $47.52. So in plain English, the way this trade works is that as long as Draftkings finishes the upcoming week above this red line right here, we are going to hit max profit, and that max profit is about $240, which, that covers an annual subscription to HT Premium, just saying. But we love the way that this sets up from an odds perspective. This thing hasn't been at this level since, let's go back a little bit, hasn't hit this price level since July 21st. And when it did hit this price level, it bounced off it once, bounced off it twice. So using that little bit of technical analysis in addition to the cushion that this trade gives us, gives us a little bit of confidence that even if it does get back down to this level and continue the slide, we're going to see some sort of bounce off this level and it won't break too far below, so we could manage it from an HT wheel perspective as well. But to get implied volatility off the screen and start talking about RSI a little bit, it's getting very, very oversold on a 180-day basis. The reason we love RSI so much is because it's a relatively good predictor of short-term price movements, right? When we look at the red, meaning over 70, meaning it's overbought. Last time it got into the red, it got overbought. It came right back down. It gets into the red here, and in the short term, comes right back down. Gets into the red, levels out and comes back down a bit. But now that it's in the blue, we could expect some sort of short-term rebound. So that's kind of what we're banking on with that one. But again, even if it does continue to drop, that's a company that I like, and I'm perfectly happy to hold some shares on that and continue to lower the basis through covered calls on a weekly basis. APT, we talked about that one a little bit earlier as well. We got in when it was trading at 775. It dropped, almost 8% on us in 1 week. Not ideal, but we were able to get our break-even price down to 713. So again, it's one that's perfectly manageable. Just let it ride this week, see what happens, and then go back for covered calls again next week if we haven't gotten these called away already come October 1st. Forgot where I was real quick. There we go. Crsp is another example, similarly to a Draftkings, of a stock that we just like that offers, relatively decent premium on a week-to-week basis. These 110 strike puts offer about a 1% ROR. If we could pull up Crsp, pop over the trade tab really quickly. There you go. These 110 puts that we sold, a 1.08% ROR. Really solid value right there, because our break-even price is going to be roughly 108.80. If we draw that on the chart, that might be what we already drew, but we could try this again. 108, that's close enough. So as long as it stays above this red line, we're going to make money on it this week. And the last time that it traded at or below this level was all the way back in May. And another common theme that you'll see right here, you remember the Draftkings chart that we took a look at where there was support at that red line that we drew. The reason we chose the strike that we did right here, if you take a look back to June 3rd, it bounced off of here. You take a look back to March 29th, bounced off. Take a look at March 8th as well. It also bounced off of this, 108, 109-ish level. So we're perfectly happy to get into a trade like this that offers a 1% weekly return, because the other thing that we like to mention so much here is how much a 1% weekly return actually is. If you pop back over to our website, go over to tools, we've got the Annualization Calculator, right? So if we open a trade last Friday, it expires this Friday, and we pull a 1.1% weekly return, that's a 7.69% 76.90% annualized return, which is a really great number. And then we play the fun game where if we started with $15,000 and we got a 1% return every single year, you've got $250,000 by the end of year 5 right there. So for those of you who are coming from an option buying background and might say, hey, 1.08%, that's really not that much for a 1 week period. The answer is that if you keep targeting this 1.1% and you trades that are very high percentage, where there's a very good chance that you hit that 1% and do it over and over and over, the returns are going to look very, very, very nice. So that's the idea behind that one. We're not going to, we're not going to stick our noses up to a 1% weekly return, because quite honestly, that is what we're going for. And we've got a predictable comment maybe in the Twitch chat saying compared to crypto, it's nothing. What I will say about crypto is when crypto drops 10%, we are not going to be dropping 10%. The volatility in crypto is definitely crazy, but it comes with the risk that it carries. We're not going to be losing 10% on a weekly basis. We're not going to be losing 5% on a weekly basis. So while the gains may be lower over time, this is how we're going to be looking. This is this general trend up and to the right that we are going to be seeing, because we're building small gains on small gains. And while some of these people might say, hey, that's kind of a small gain, the fact that we're at a 91.91% yearly gain, that's not a small gain. That is a massive gain on a yearly basis, and it's something that we're going to try to be keeping up as we head into the future here. But with that in mind, back to the tracker that we have set up for this week. SOL is another stock that got down into a level 6.5 strike. Every time it gets down to this level, I'm perfectly happy to play it back up. This is a solar company. And again, we talk about industries that we're bullish on. We got in on Draftkings because we're happy with the gambling industry and where that thing looks like it's going to be. But this is another one. This is a green energy company. I'm really bullish on green energy companies for the near term and I guess long term future as well, because I think we're kind of inevitably heading down that road where that's going to be the future. But with that said, every time we get down to the 6.5 level, we are perfectly happy to play ball, and that's exactly what we got here. Let's go to the 180 day again. I guess you can't really see too much from the 180 day because it's so zoomed out. But it could get back down to about 611. That's something that could happen. But knowing that we sold a 6.5 strike put for 25 cents means our break even is going to be 625. So as long as it stays above here for the next 5 days, we know that we are going to make some sort of profit. And as long as it stays above the red line right here, where if we extend this out to the left, we've already seen some support demonstrated at this level over the last month or two. This is going to be a profitable trade for us. And we got that question saying, does DCA work in stocks? Why am I pulling a huge blank here? Basically, like averaging down is, I believe, what that stands for. And why I'm pulling a massive blank on the screen. Dollar cost average. There we go. The dollar cost average. So the idea with the dollar cost average is you just keep, if something drops, you just buy more and you lower your average. The question is, does that work with stocks? What we do with options, it absolutely works, right? Because using APT as an example, we entered at 775. It was, it dropped down to 714 to where it is. But even though we started playing it at 775 on September 22nd, which is just last Wednesday, we already have, off the bat, we had a 728 break-even price. It kept dropping, so we sold covered calls. We now have a 713 break-even price. That dollar cost average, or I guess the general idea behind that with lowering your break-even price and lowering your basis, is something that I think is even more easily achieved in the option selling world, which is why we do what we do, and this is how we effectively do that. So that is, I guess, my little 2 cents on that one. But again, SOL, max profit going to be above this point where we've already seen support demonstrated. Any profit at all is going to be above 625 right here. So we are perfectly happy to play SOL anytime it gets down to that level. And again, even if it does drop below 625 this week, no problem there. We're going to sell some covered calls. We're going to take assignment. We're probably going to sell some cash secured puts because unlike APT, this one actually has option strikes at every 50-cent interval, so we'll be able to take advantage of that to play defense if that moves against us. DMYI, another really similar setup to some of the other ones that we've played so far, DMYI. And I believe this one was called out by Nation in our Discord server. So with that one, right, it's at 11:30. They're about to undergo a merger. So again, typical SPAC setup. I believe the merger is on September 28th. There you go, September 28th. I guess that's the meeting to approve the deal. I'm not entirely sure when the actual merger itself is, but same idea to where even though it is a SPAC and it probably will go down if I had to make a guess if I were a betting man, the idea is we sold this 9-strike put and we were able to get 65 cents of premium. So our break-even price is going to be 9 minus 0.65, meaning we have an 835 break-even price on this one, and we have to zoom out on the y-axis to get there. That's how low it is, right? So that's about where our break-even price is as long as this stock finishes above this red line in the next 3 weeks, because the expiry on that is going to be October 15th. We are going to make money on that trade, and I'm happy with the way that one stacks up. And again, it was a 9-strike put, so max profit is going to be above the level at that red line. So we jumped in on that one Friday afternoon. I think it's already down to 58 cents-ish. So at least for the upcoming week, got a little bit of profit on it. And then CLOV, very similar idea there. Once again, if we go to CLOV, anytime this thing gets around 750, we're happy to play ball. If we zoom in, I guess maybe the last 20 days might be a little bit better of a look. But we like to play it around the 8 level. We like it even more now that it's near 750. But again, we sold 750 strike, which is max profit for about 17 cents. So our break even is going to be right around there. If we zoom back out to that 180-day chart and extend these to the left, come on. There we go. You'll see historically it can get a little bit lower. It can get around 6, but every time it's even gotten lower and gotten around this 6.50-ish, $7 level, it's bounced up pretty quickly. So that's one where we're happy with the way that one sets up, especially on a short-term 5 trading day basis. And again, that's one I sold it for 180. So if that one expires worthless, we're taking home $270, right? If this one expires worthless, we're taking home $250. And between these two, that's $500 of profit. We're collecting base hits and we're turning those into some high scoring games. LIDR to top out the list is really similar setup, although this one pulled back pretty hard at the end of the day on Friday. But we're set up with 750 for the upcoming 3 weeks, and we were able to get 73 cents a premium, meaning that break even is going to be 675, a price that it hasn't traded at yet. So it's going to have to make a new low in order to make us lose money on it. And even if it does go that low, once again, we'll remember that we could just take assignment, 675 basis, sell covered calls, and then move that basis even further down as we head into the future. And again, with these former SPACs, the idea is that at the date of transaction, the value of the company that they've bought public really is roughly $10 a share, because that's the value of the cash being used to facilitate that transaction. So while things can drop below 10, fundamentally, can a company really lose that much value in that short of a time frame? The answer most of the time is, really no, it can't. So that's why we enter into these high percentage trades where, and even if it does keep pulling back, like we've seen with Ride as an example of a company that absolutely sucked after the merger and pulled back, but even some of the worst mergers have little rebounds. So there's plenty window of opportunity for these things to keep moving and get back into a range where we could close the position out for profit. So this is one area that I think has provided a lot of opportunity, these former SPACs lately, just because of how volatile they've been. A lot of them are being pumped up. So a lot of people are perfectly happy to start getting into those trades, and that provides a lot of premium for us to take advantage of. But top to bottom, that's the list that we've got going. One little aside that I do want to talk about, upcoming earnings, we don't really have too much. Let me pop over the Discord server because I put a picture in there for upcoming earnings. What we have for this upcoming week, not too exciting, indicated by the yawn emoji that I threw in there. But I think Bed Bath & Beyond, really the only company of note. Obviously, Micron is a decent company, but for earnings, I like to target Wednesday afternoon and beyond, because you get that drop off in implied volatility that comes with the end of earnings, and additionally, you get that super exponential pace of theta decay that occurs in the last couple days of a week before expiry. So you got two things working for you. That's why typically if I'm making a play on earnings, I want it to be Wednesday afternoon or later. So in that window, Bed Bath & Beyond, really the only kind of only stock that fits that criteria. And for this last week, Nike and Costco fit that criteria as well, right? They reported Thursday afternoon. So they were a couple that we took a look at for earnings. So what's, I guess, one good way to talk about this, we could use BBBY as an example, because that's going to be one for the upcoming week. We want to use the concept of implied move to help us figure out where we want to sell options, right? So with Nike, the implied move was $10.28 via IV, which is the number that you see right here, which is, a couple standard deviations away from the current stock price. And then there's an MMM, which is the market maker move. And that's this yellow number that you see up here. So what is this? It's a Thinkorswim thing where TD Ameritrade says it's a proprietary formula used by market makers to determine the amount of move that you could expect to see on front month options, or front expiry, meaning the next expiry of options in the chain. So for here, we would see that it's October 1st, 2021, meaning that we would expect there's a 232 move by then. So the way that we would do that, right, is since I do a little bit of the analysis and it's kind of a pain in the ass to do it all manually, I built a little thing in up here. If I could get up there. There we go. So BBBY is the stock, trading at what, $22.95 as of close, and we know that the expected move that it's telling us is 232. So we'll put that in right there, 232. And that tells us the expected range is going to be 2063 to 2527. That's a 10.11% expected move. And to potentially address a question, you might say, hey, HT, little question. We have TD Ameritrade's market maker move of 232, but that's, decently different from the implied volatility move of $3.06. So how do we make sense of that discrepancy in those two numbers? So this really is based off the break-even price of an at-the-money straddle, meaning if you added the two amounts of premium together that were quote-unquote at the money, so basically 23, you'd add that like $1.50 to another $1.50, you get that $3 of move in implied volatility. So what this tells you is that the amount of premium that's in the options is based on this big of a move. So the higher number, the better. The higher the implied volatility, the more premium. Now, the significance of this being a plus or minus $3 move, and this being a plus or minus 230 move, is that this proprietary market maker formula is telling you that the actual move is probably going to be less than what's implied by the premium in the options. So what that means for us is that there's an opportunity as option sellers, right? Because the premium is greater than what it should be. So a little bit of an edge to the option sellers there. Now, when I plot these out and plot the expected ranges, I kind of tend to ignore this number and go with this one because I found this one to work out a little bit better. So back to our example where there was a 232 implied move. We know that that range is going to be from 2063, so we could plot the bottom end of that at 2063, and we've done this before in the past. Hold on. So let me remove these drawings. Come on. Oh my gosh. There we go. So we know 2063 is going to be the bottom end of the expected range. And if we go to the top end of the expected range, that's going to be 2527. So we could plot that right about here. There we go. I kind of missed it, but there you go. So the way that I like to look at this is first starting out kind of shorter term, looking at the 20-day, and then backing up to see the 180-day. And the reason why I do this, we can actually take you quickly through what I did this past week on one of these earnings primers blog posts. What am I doing right now? There we go. So every now and then we'll post one of these when there's a couple interesting options opportunities coming up from an earnings perspective. Here's one we did with Nike and Costco. I might need to zoom in a little bit on that. But idea being the same, right? We had the current price of Nike. We put that expected move in there. It gave us the expected range, and we plotted that expected range on the 20-day chart. So this one came in 149.52 and 169.20, meaning that we could reasonably expect it to stay within that range. Now, if we look at the 20-day chart on Nike, you'll see that the stock stayed within that 20-day range, which is a good sign. What you don't like to see is when you look at the 20-day range for Costco. It ran a little bit out of that range. So like we talked about here, there's some upside risk if you're taking a bearish position, right? Because it broke out of that range in the last 20 days. That really is the kind of risk that you would see right there. You like to see support and resistance on both of these lines that we plot, because that could give you, outside of just using that expected move for information, that could give you a little bit extra confidence that even if the expected move is there to stop you, there might be support or resistance to stop the stock as well. But going back to Nike, right, we took a look at the 20-day, it stayed inside the range. We go back to the 180-day, and it came a little bit outside of the range here, and there's a big gap down below the range. So that's why we decided not to play it. But let's take a look at how Nike turned out, right? So we plotted this expected move. That's not Nike, that's MKE. God, it is. We plotted this expected move, and it turned out pretty much on the money, right? We saw that in the last 20 days, it stayed within the range. We knew the bottom end of the range was about 149.75, and if we look at what actually happened, Nike closed at 149.59, so pretty much dead on the bottom of that expected range that we plotted. And I think the expiries from last Friday are gone. But point being, if you sold options outside of either of these ranges, they were going to expire for max profit and make you some money. So that's why we like to use that idea of the expected move to plot where we think a stock is going to move after earnings and decide to sell options outside of that range that we plotted. And back to the point to, I guess, close the loop on what we looked at last week, Costco, it went outside of that 20-day range on the upside. So we said there's going to be some risk right there. If we take a look at COST, that's exactly how that played out, right? Because we like the idea of support, and typically like a short-term high acts as support, excuse me, as resistance rather. And that's exactly what we saw. When we drew this line here, there wasn't a ton of support, but we followed the numbers. We put math on our side and tried to plot it out that way. And it initially did move right up to that edge, but after open, that upside risk that we identified kind of came true, right? We said there's going to be some risk because it broke out in the short term. And if you look at where it ended up, it went right back to where it was on that short-term breakout of that range. So that is how you use those expected move statistics to help figure out what you want to do for earnings. So back to what we're doing right now with BBBY. This is that expected move, and over the last 20 days, it's broken well out of the top end of that. So that would tell me I really don't want to take a bearish position. I don't want to sell calls on the upside of this range, but that might say, hey, there could be some decent opportunity to sell puts on the bottom end of the range. So let's back out to the 180-day chart, and you'll see that there really isn't a ton of price action down around this lower level, which kind of gives you the all clear to say, hey, I think selling puts around this 2064 level could be really advantageous, right? So if you sold a 20 strike put, you could pull a 2% weekly return on that, just using this information that the expected move gives us. Because over the last 180 days, yeah, this thing's run like crazy out the top end of the range, but hasn't seen a ton of action on the bottom side. But let's see if we can zoom out even further to find an area of support. And this is what we kind of see right here in this range from October of 2020 to midway through January of this year. So the bottom end of the range, that 2065 that we have plotted right there, starts to get near where we last saw some support in this area on Bed Bath & Beyond, which is in the 1839 range. So using that 1839 idea of support, let's try to sell something that gives us a basis in that area. And I think the answer to that would be a 19 strike put, which would give you an 1880 break-even price. So if you saw the 19 strike put, gives you a break-even price of 18. Yeah, I'm getting close. I missed. Hold on. There we go. 1880. So if we extend this one out to the left, there you go. That's a lot more in line with the previous support that we've seen on Bed Bath & Beyond. And while this is decently out of the money, the 19 strike put, let's not forget that this is still a 1.09% return on capital risked. So, and even better, we like to leverage, right? If we wanted to sell one of these, we know that cash secured, it would take about $1,900 to do so. Using some margin, it would only take about $1,200. So you don't save a ton of money there, but it still does make your ROC a little bit better. But the 20 might be good as well too, because that gives you a 1960-ish break-even price, which is right around here, and still kind of falls back in line right there. But point being, we plotted this expected move. We don't like the upside because when we took a look at the 20-day chart, it spent a lot of time trading above there. But what we do like was the fact that if we back things up, there's some decent support on the downside, and it really hasn't touched these levels in a while. So there's decent premium because of the earnings. I like the setup. I like the support down here. 19 or 20 strike puts aren't going to be a bad idea for earnings this upcoming week. But to further that point, we're doing this all on Sunday morning, right? They don't report earnings until, if we take a look at this, that's the old one, but they don't report earnings until after market before open on Thursday. So really the ideal time to do this exercise again is going to be Wednesday afternoon, because something could happen between now and Wednesday where the price moves all over the place and all of a sudden you're pushing up on 21 before they even announce earnings. So we want to eliminate that short-term price risk before earnings and make sure we're purely playing earnings by just waiting until Wednesday afternoon. We're going to do this again, and then we'll make our decision from there. The implied volatility really isn't going to go anywhere until after earnings, so you don't need to worry about that premium disappearing because you're waiting a couple of days. So that's how that works, and that's the idea with those earnings trades. It's, kind of a dry week upcoming for earnings, so there's not a lot going on, but that's what we've got our eye on in that regard. And I guess to wrap things up, we could take a quick look at the scanner. We did have a couple questions in the chat, or I guess one question saying FFIE 9 strike put, is it a good trade? And if you look at our tracker, we've played FFIE almost every single week for the last month, right? We sold 9 strike puts last week. We sold, there it is, 8 strike puts the week before that. We sold 8.5 the week before that. We sold 8.5 the week before that. And there you go, 8.5 again, right? So this thing, FFIE, has kind of been a little bit of a moneymaker for us. However, The issue with FFIE is it started to run away a little bit up to, I think I have it on the watch list. I do not have it on the watch list. What's happening up here? Closed Friday at 11.14. So it's starting to run away from us a little bit. And this 9 level that we would have liked to get in on, it's the premium's back a little bit to about 10 to 15 cents a piece. Ideally, I would want like 15 to 20. But again, I'm not going to contradict what I said earlier. It's never a bad idea to get in on a trade where you're pulling about 1.41% return on a weekly basis. And to further that discussion we had earlier about potential margin, it would take about $900 to sell one of these. Thanks to margin, it takes a third of that. So you can really multiply this return by 3 from an ROC perspective, right? So you really would be getting about a 4% return on capital on a weekly basis, which is very, very, very nice. And to top that off, Thinkorswim thinks this thing's only going to move about 37 cents in the upcoming week, whereas these are priced for $1.52 of a move. So there's some massive, massive opportunity in that regard. So, if you can get 15 cents, I don't hate it. I think 2 or 3 days ago, these were offering a lot more than they are right now. We could verify that claim by taking a look at the price action on this. If we go back to the 20-day, earlier last week, these things were offering about 30 cents a piece, which was a beautiful, beautiful value. And I definitely had my eye on those for this upcoming week. But price ran away a little bit. The premium dropped off. Such is life. We could move on to a different stock, or we could, stay stubborn, put an order open for 15 cents to see if we can get that one filled. But that's what we're looking at with FFIE. Definitely one that we're going to keep on the watch list because that premium has been very good on a weekly basis. We just maybe want to wait for a little bit better of an entry because this thing definitely has its fair share of red days and big red candles that you'll see. So hang tight on that one, I guess, for now until that offers a little bit more premium. And Cash Money saying he hopes TMC bounces like Ride. You and me both, buddy. I would love to get a little bit of cash back on that one. We can take a quick look at the scan really quick to wrap things up. We're coming up on about an hour 30 of the stream. Again, we're going to go to load, scan, query, personal, high ROR puts. We're going to do the ones without earnings. And if you want to have these load up into your scanner the way that we have them, there you go, HT Premium. We've got links to import all of these into your very own Thinkorswim module. Let's see what we've got coming for the upcoming week in the market. IRNT, and this is another very important discussion too, because when you take a look at a scanner, this is going to look crazy, right? We talked so much this morning about, hey, I love 1% a week. I love 2% a week. And you're seeing something up here that offers 17.5% a week. But let's take a look at what that actually is. IRNT is IronNet, former SPAC. And these are going to be pretty much dead at the money. 24 going for about $3-4 a premium, meaning your break-even price is going to be in the low 20s. Do you want a break-even price in the low 20s on a stock that previously was trading around this $10 level and has, every right in the world to fall back to that level? Because as we mentioned earlier, to justify our potential downside risk, saying, hey, a company can't really lose value this quickly post-merger. It's tough for a company to gain value this quick post-merger. So that's what we want to keep an eye on, right? And if this looks appetizing to you, just keep in mind that if you have a $21 basis on something that drops down to $14, you're looking at a 33% loss in 1 week. And that's something we definitely want to avoid because that kind of a trade is killer. So that's why just because something's at the top of a scanner on a week-to-week basis doesn't necessarily mean it's a great idea. However, you can use this kind of info to say, hey, FFIE, we see an 11 strike put. Let's go take a look at FFIE as we just did a second ago. And you'll see that hey, that's a really nice 8.64% return, would give me a 10-10 basis. But, former SPAC, I don't really want to own it above 10. Just because 11 is the strike that came up on the scanner doesn't mean 11 is the strike that you're going to have to sell. If you see something on here where there's 8.64% of premium, that almost definitely means there's options further down the chain. They're going to have decent RORs as well and give you a much more advantageous cushion. And that's what we see right here with FFIE. So that's how you interpret those scan results. Edit is one that has a lot of premium, but that's a healthcare. SAVA has a lot of healthcare. Just not loving what we see in the scan so far this week. So we're going to hang tight, right? TMC, we already have a trade on there. FFIE said we might take a look at those 9 strike puts. Outside of that, I'm kind of going to hang tight. We love the IV reversion opportunities, and those are ones that come more so on an intraday basis as opposed to presenting themselves to us at the beginning of the week. So that's what we've got set up for this week. Had a really good week last week. We've had a really, really good run in the market lately, and just has continued to build on what we've been building this entire year, as we're up to basically a 92% return on the year. We're gunning for that triple-digit percent return, and I like the way that we're set up, right? Again, going through the exercise of, TMC's at 5.11, this will be worth 39 cents at expiry. This will be worthless. This will be worthless. These three will be worthless if those stocks remain flat. So we're already deriving a 1.73, about a $3,000 return just from those weekly options we have. And that's ignoring the fact that, during the week, we're going to see some opportunities in the IV reversion department. Try to get some more of these where we piece together a couple $100 at a time. Add to that, have some of these longer term plays adding to that as well. And I think objectively, I'm happy with where we stand. I like the fact that we rolled TMC to October 1st and didn't get too caught up in the sunk cost fallacy right there and give ourselves a trade that would continue to hammer us week over week over week. I think TMC, these 5-strike puts, or something I would open even if I had no money in the market. I think this is somewhere I would put my money in. That's a good way to evaluate whether or not you should stay in a trade or not. If you had 0 positions in the market, is that trade something that you would open regardless, or is it something you're just kind of holding on to because it's a loser and you think it might turn around? If there's better places for you to put your money, do not be afraid to cut a loss and move on to the next one. But this is what we've got set up. I think we had a really good discussion about what we saw for the past week, what we saw for this upcoming week. I think that earnings discussion that we had was really valuable. We're not in earnings season right now, but that's a concept that's going to be coming back around because, earnings season happens about 4 times a year. So if it's not earnings seasons right now, that means it'll probably be earnings season again pretty soon. So that's something we'll have to revisit. We'll definitely be coming back to in the future as earnings season comes back around at some point in the next few weeks. But that's what we've got. Thank you to those of you who tuned in for the special Sunday morning edition of our stock market scan. We are going to cut it off right there. Gotta hit you guys with the same corny outro that we give for all the videos, saying this has been Hourglass Trader, where as time passes, we make money. Thank you guys for watching. We hope to see you again this week in the Discord survey and again next week on the stream.